Hi guys, hope you're all doing well. Central Bank of Nigeria holds interest rates at 26.5%. What it really means for your wallet, your businesses, and Nigeria's economy. Part 1. Imagine trying to build a factory and the bank tells you, we will lend you money at more than 32% interest. Would you borrow? Probably not. Now imagine millions of businesses facing exactly that reality. That is Nigeria today. Why many countries are beginning to cut interest rates to stimulate growth? Nigeria continues to operate one of the tightest monetary policies anywhere in the world. The question is why? And perhaps even more importantly, can Nigeria actually grow under such conditions? One decision, 11 policymakers, 26.5%. And that single number could determine whether you get a business loan, whether your mortgage becomes more expensive, whether food prices keep rising, and whether the naira remains stable, and whether foreign investors bring billions of dollars into Nigerian economy. The Central Bank of Nigeria, CBN, announced that it is keeping its benchmark interest rate at 26.5%. But here is the question. Is this protecting the economy or slowing it down? Let's break it down in simple terms. This is Econoscope, your front row seat to the global economy, where we break down global headlines and explain what it means for Nigeria and Africa's economy in real time. So if you follow this channel, you already know that we don't just report the news. We explain what it means for your money, your business, and Nigeria's future. Let's dive in. So following its 306th Monetary Policy Committee meeting, the CBN left all its key monetary policy tools unchanged. That includes monetary policy rate, MPR, 26.5%, cash reserve ratio, CRR, 45% for commercial banks and 16% for merchant banks, standing facilities corridor, SFC, plus 50 / minus 450 basis points. Cash reserve ratio on non-TSA public sector deposits, 75%. This may sound like technical jargon, but together they influence almost every aspect of Nigeria's economy. At first glance, nothing changed. But in economics, sometimes doing nothing changes everything. Because by refusing to reduce interest rates, the central bank is effectively saying inflation remains a bigger threat than slow economic growth. So, what is the MPR? The monetary policy rate, MPR, is Nigeria's benchmark interest rate. Think of it as the master interest rate that influences how much banks charge customers for loans. So if CBN raises the MPR, loans become more expensive, businesses borrow less, consumer spending slows, and inflation may reduce. Where CBN cut the MPR, borrowing cost becomes cheaper, businesses invest more, consumers spend more, but inflation could accelerate. By leaving the MPR at 26.5%, the CBN is signaling that controlling inflation and protecting the naira remain its top priorities. What is the cash reserve ratio, CRR? Imagine customers deposit 100 million naira into a commercial bank. With a 45% CRR, the bank must keep 45 million naira locked with the central bank and can use only the remaining 55 million naira for lending and other banking activities. That means less money is available for loans, credit becomes tighter, lending rates remain high, and inflationary pressure is reduced because there is less money circulating in the economy. For merchant banks, which mainly serve corporate and investment clients rather than retail customers, the CRR remains lower at 16%, reflecting their different business models. So, Nigeria's CRR is extraordinarily high. Let me stop the video here. We'll talk about why Nigeria's CRR is extraordinarily high in part 2 of this video. Stick to Econoscope. Like our content, share, and engage. Bye.